Okay, good morning and welcome back everyone to our Monday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I'm joined here today with a very special guest, Steve Sosnick from chief strategist at Interactive Brokers. And we have a very interesting discussion today to talk about for those of you that trade the Canadian markets, whether we're trading Canadian equities with the banking industry reporting earnings here in a couple of weeks. We're going to have a discussion around that. We're going to talk about trading gold and how to position yourself currently if you're thinking about another move here in gold as we're starting to see this morning, and also talk a little bit about the dollar CAD as we've seen some moves here from the dollar and Canadian. So we want to cover those things here with Steve. Now, before we get into that, my name is Tony Zhang, but what we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, normally on these shows, on these Monday morning shows, what I do is I talk to you through my charts, my research that I'm currently looking at, and the ideas that I'm currently having in the markets. But today I'm joined with a very special guest, Steve Sosnick from Interactive Brokers. So Steve, if you, I know most of the audience here are familiar with Interactive Brokers, but if you could give us just a couple of minutes as to your background as far as your history at Interactive Brokers, that would be great.
Well, first of all, let me say it's a pleasure to join you, Tony, and thanks to the MX for hosting as well. I joined the firm in 1990. When did I join? 1995. It's been a while. I was previously an international equities trader and warrants trader at some of your bigger firms, two of which don't exist anymore, Solomon and Lehman. But I had nothing to do with their demise. I was long gone by both of those. So I joined the firm because basically we were primarily an index options and futures trading firm. And we were getting into the equity business, and I was brought in because I had equity trading and equity derivative experience. I remember someone telling me, don't expect to stay very long, because we had all these floor traders, and for many of them it was a stepping stone to do other things. And so, 20 some odd years later, I'm still here, almost 20, it'll be 25 years in December, actually. And one of the first things I did, having had a significant international equity experience, I said, we got to get into Canada. That was one of my focuses when I was at previous roles. And so I knew the markets well already by that point. And so we we hired someone in Toronto who started trading. We always start sort of with index futures, and we traded we got some people on the floor there, and pretty much within a couple of months after getting geared up in Toronto, the Big Bang happened, and we had to move them to Montreal. Fortunately, most of them stayed and ended up becoming, one of them swears to me he'll never go back to Toronto. He lives in Montreal now, and will never go back. So we got that going. And then, of course, when the exchanges went fully electronic, that was something we were ready for. And so we stopped, as a firm, we stopped making markets. And this has nothing to do specifically with Canada. Actually, we stayed in Canada longer than we did in most places. We stopped making markets as a firm-wide decision to focus on our retail and institutional execution businesses and clearing businesses. The analysts always hated our market making, because even though we never lost money, they always saw it as a potential pitfall. So, sort of jettisoned in the name of progress. As a result, though, I'm able to talk much more about markets. I'm going to give the same disclaimer. Anything I say can't really be construed as a recommendation. Although I'd love to talk about all this stuff. But as a result, I've probably traded as many options in Canada as anybody, at least electronically speaking. And so I have a long history there, and look forward to discussing it now with you.
Yeah, and I think a lot of the viewers here actually have accounts at Interactive Brokers, and I really like kind of the fact that, having a guest on that comes from the market making background, because we do get a lot of questions from, the other side on the trading side, what actually happens, to my trade on the other side? Is there someone on the other side that's making money when I'm losing money? These are the types of questions that we get a lot of times from retail investors, and I love having, guests that can provide a different viewpoint than what we typically have on the sell side. So great to have you here. So let's go ahead and get started. Now, so I always like to update a little bit as to what's happening on the broader equity markets. So we always start off with XIU. So Canadian markets, looking fairly, didn't recover as fast as the S&P 500, but that's mostly due to the fact of the constituents in the Canadian markets are very, very different than the S&P 500. But over the last couple of weeks, last 3 or 4 weeks, the Canadian markets keeping pace with U.S. markets, actually breaking back to new relative highs, hasn't gotten back to those February all-time highs versus the S&P 500, obviously just within spitting distance from that February all-time highs. What are your thoughts here as far as the directional view of the Canadian markets, especially with, respect to, can it catch up to the S&P 500 given the constituents of the two markets? Kind of, do you have any thoughts on from a macro perspective?
Well, I think if it catches up, it's going to be more on a relative basis, because the Canadian market, and I'll use the TSX 60, which underlies XIU. The problem it has vis-a-vis the S&P 500, or certainly the NASDAQ 100, is in Canada you've got one high flyer, Shopify, moving the ball higher regardless. It's just sort of one of these bulletproof, let's find safety in incredibly highly valued stocks kind of mindset right now. But beyond that, you've got this huge weighting in banks, and banks are not the place to look right now. The market doesn't perceive it that way. And I know we're going to talk about gold later, but Warren Buffett has pretty much made that call for us as well sometime in the last quarter, in a US sense, by moving out of banks. And so while you have the precious metals exposure in Canada, while you have the leading stock in the index now sort of falls under that high-flying mega cap tech idea, you still have a lot of banks, and banks are hostage to the interest rate cycle, and that is not all that friendly to them. And the good thing is they're really well-managed, boring businesses. In a high-flying market, that's not necessarily what people want. They want some sex appeal, and that is one thing that Canadian banks lack.
Right. The Canadian banks do have a slightly higher dividend yield. Thoughts on kind of, if the Canadian banks are stronger than the U.S. banks?
Stronger is a tough one, because probably yes, but it's so relative, because the top U.S. banks, which are bigger than the Canadian banks by a fair margin, really are at this point too big to fail. So I don't know that it's I think that the Canadian banks are managed more prudently, because I don't know that they have that mindset. I think they're much more, they're much, in many cases, they're more domestically focused. That's not, it's not fully true, because they have different banks have different global exposures. But I think in general, they're perceived as a bit more staid, a bit more stodgy, a bit more reliant on fee income, which is a good thing if you're a bank, but you don't necessarily have the Federal Reserve putting your arm around the shoulder and saying, "Don't worry about it. We got your back. We take all the risk you want. We've got your back." So it's,
yeah, and that's exactly what you and I spoke a little bit about before this call, which is really just, and a lot of retail investors have been asking over the past couple of weeks, or rather past couple of months, I would say, as to how equity markets can continue to trade at these types of valuations, given the economic and fundamental backdrop that we currently see after COVID-19, and seeing equity, the S&P 500 back at February highs, the NASDAQ 100 well above its February highs, and, the Canadian markets not too far off from those February highs. How do these valuations make sense? How do investors still continue to take long positions in these types of markets? And I know that you and I discussed a little bit, but perhaps you can share with investors kind of some of your views on that.
Well, I think right now you have this mindset that the world's central banks have your back. And the shorthand for that is the Fed put, but it's not just the US Fed, it's the global central banks, because to some extent they all moved into action. I mean, even the ECB got moving, and European governments got together for fiscal stuff. The problem now is, I wonder how much the markets are overvaluing those puts. I think that, and again, I'll use the Fed because they're sort of the biggest bank in the room, so to speak. If you look at the balance sheet, the Fed's balance sheet, it's been dead flat for a few weeks. They've sort of honed in on this $7 trillion number, which by the way, is roughly the combined market cap of Apple, Amazon, Microsoft, Google, and Facebook. So let me just throw that out to the room. But you've got the Fed sort of saying, we'll be there, we have your back. So that's a put. I don't know where that put is struck. Is it down 5%? Is it down 10%? And in the US, certainly there's all this talk of fiscal stimulus, which would be helpful to markets around the world, because when the US catches cold, everybody sneezes to a certain extent, and particularly Canada over the years. What I think you end up seeing is the markets have sort of moved on. Okay, so the Congress can't get together, but they'll do something. I actually almost think fiscal stimulus has become another put. And the mindset I think you get from investors is, well, it's safe to go in because I'm not really going to lose anything. That is usually a bad mindset, because I don't know where it struck. I don't know the timing. The fiscal stimulus, especially, these guys can't agree on where to eat lunch, let alone how to spend money. And so let me put something to you a little bit differently. And this is sort of my case study. Over the past 12 months, Apple is up about 130% or so, depending on where we are at this moment. Now, I'm going to pick on them because they're the biggest. Their earnings their rolling 4Q earnings are up 12% in that period of time.
Yeah.
What is that telling you? That's telling you that there's a lot of money chasing a lot of stocks. Now, to be fair, Apple's shrunk their share count, so their PE, their earnings per share have actually increased greater than 12%. But the bottom line is, it's really, there's a lot of money chasing a lot of stocks globally, chasing a lot of risk assets globally. You can see the same sort of thing in many fixed income markets, where people are chasing lower credit and longer maturity, which is effectively really moving out the risk curve, but getting less in return. I think you've got a real risk on mentality. And I don't like to break the days or the weeks or the months down to risk on, risk off, but you've got this huge risk appetite, whether or not that's the result of, I'm just going to say, yield hunger. But that's really that's so much of what we're seeing. And that, to me, you got to wonder, are the markets getting out over their skis a bit? But it's hard. You can't fight this tape in the short term.
Yeah, so there's absolutely this dangerous precedent that's been set now with this risk on market, and like you said, I would argue that it's purely just chased on yield. I mean, if we look at valuation metrics on all fronts, it is extended, would be an understatement, with the exception of the dividend yield in comparison to, let's say, the 10-year or the 2-year. Historically, we have never seen the S&P 500 yield 5, 6, 7, 10 times the US 10-year or 2-year yields. So that is the only valuation metric that I think the market is driven off of at this moment. And I think that we're in the process of watching a bit of a bubble being created. As far as when does that bubble burst, I have no idea. Just the same way as you said, where's that put? I don't know. But and what is that catalyst? It could be a number of things that drives, the bursting of this bubble and the move to the downside. But I do think that move, the next move down we do have, could be fairly fast, fairly violent, and perhaps even bigger than what we saw back in February.
One advantage that Canada has in going through your point is because you have the banks, which have very good yields as such a high percentage of the market cap, that does give you some insulation that you don't have. In the case of, Amazon doesn't pay a dividend, and Tesla doesn't pay a dividend. The yields on, Apple's starting to get into the game, and Microsoft, but you're not in the U.S. You're being the problem is you're not being driven by the dividend payers even. So
right.
The dividend payers, the steady dividend payers are not the stuff leading the market. In either country, at least in Canada, as a weight, you have a higher dividend paying group that is on top of the index. But that's really what this is just, it's beyond. That's the one valuation metric that looks okay, and I think that's just because people have been overlooking dividend stocks in favor of more excitement, for lack of a better word.
Yeah. So in light of the dividend topic, let's talk a little bit about Canadian banks, because Canadian banks are going to report earnings next week. We have a large number of them next week. And, if we look at XFN, which is the iShares TXX financials index in Canada, it's a fairly weak ETF compared to the overall equity markets. As we know, banking, with the exception of energy, is the second worst performing sector. You've got this double top here on XFN. From my perspective, I actually found it kind of hard to believe that these banks can continue to rally from here in the interest rate environment that we're currently in. Do you share similar type views with respect to kind of how far banks can move here?
The game is sort of rigged against them at this point. Now, that said, we've started to see the yield curve steepen. Sorry, I lost the word there for a second. We've started to see the yield curve steepen. That's what the banks need. Now, obviously, they would probably like a higher level of interest rates overall, but that's not necessarily how they make their money. They make their money there's a certain amount they make just by sitting there overnight, but for the most part, they do make their money by playing the yield curve. You're seeing demand for mortgage refinancing and for home purchases on both sides of the border. A mortgage is, by definition, they're borrowing the money short term and lending it longer term. And so getting a little bit of spread is helpful to them, but it would take, in my mind, sort of a rejiggering of inflation expectations, which we're seeing in fixed income, but not in bonds. We're starting to see it in bonds. I mean, the US 10-year take this as you will. US 10-year went from, call it 50 basis points to 75 basis points. So on an absolute basis, that's nothing. On a relative basis, well, that's a 50% move.
Yeah.
But we're still talking about relatively minuscule numbers, a relatively flat as a pancake yield curve. And that is not a recipe for banks. They with refinancing, there's fees and whatnot. But this is not their ideal environment, and it's not clear when that would become the case. I think, there are central banks that are trying to talk up inflationary expectations. And we'll get into that, I guess, with fixed income as well. But I like holding the banks. They have great franchise value in a sense. They got a nice dividend. They're not going anywhere. In Canada, you've essentially got an oligopoly on top of it, which is real market power. But to the U.S., it's pretty much true to a certain extent for the largest banks as well, because they're too big to fail, as argumentatively. So I would love to like them, but it's hard to come up and say you got to move into banks. This is compelling. You're talking about yield and franchise value rather than a healthy basic business.
Yeah. So I think a lot of investors here on this call have these banks in their portfolios. Most of them have them as long-term plays, as you say, for the dividend. With earnings coming up here, we have Bank of Montreal, Bank of Nova Scotia on the 25th, 26th, we have Royal Bank, National Bank, and the 27th, we have Canadian Imperial and Toronto Dominion. I know you and I discussed a little bit about talking about looking at implied volatility and some of the at-the-money straddles. You know, how does that look for you right now as far as some of these names, in terms of the implied move right now? If you want to talk a little bit about kind of how you look at earnings from the implied moves perspective, that would be great. And if you have any insights into any specific names.
Certainly, I had a second screen. That's why I was looking down over there, because I hadn't been logged in, and it helpfully logged out while I was paying attention to our webinar. So, but I did look at this going in, and one of the things that I noticed was there's not a huge what you want to look for is sort of 1 week to the next in terms of where the implied vols are. And while I was scanning a couple of them, next week's implied vols were not all that much higher than this week's implied vols. Let's say maybe, I looked at BMO, for example, which was, roughly a 24.5 versus a 22.5, or call it almost a 23. The reason we would look at it this way, especially when you have the granularity of weekly options, is you can really tailor your move. And in this case, all of them are next week, different parts of the week. So especially when you start to look at, like a national, or I'm sorry, a commerce or TD, which are basically the day before expiration, you're getting a pretty pure read as to that week's vol versus the prior week versus next week is not as clear, because you do get some benefit. Volatility is, I don't want to draw up my fingers, but you've got the space under the curve. And so if you've pushed up, the first week in the curve, it's going to push up to some extent the second, third, et cetera. But these are not priced, they're not particularly expensive. Now that cuts two ways. If you like to write options, you're not getting a lot of premium for them. On the flip side, if you're a holder and want to hedge, it's not particularly expensive to hedge in the banking complex across the board. One thing I would tell people to do is, well, first of all, if you've got a provider that's showing you the implied volatilities, note for these guys, we do show you those. But the other quick and dirty way you can do it is take a look at the at-money straddle, subtract out any intrinsic value from it, and you can take that into a percentage. So if you've got an at-money straddle that's worth $2 and there's 50 cents of implied, it's $1.50 for the straddle, and then you divide that by the stock price, and that'll tell you roughly what the percent, well, that'll give you a percentage move in daily percentage terms. Markets, we of course have this weird convention, which is not all that helpful at putting them in annualized terms, but I hope you've shared it before, Tony. If you haven't, the rule of 16, and that is basically you take the annual number and divide it by 16, or you take the daily number and multiply by 16. It's the square root of business days. Thankfully, it happens to be just around 256, which is 16 squared. So that's your way of doing it. You would take sort of you would take the implied move, but in a simple sense, just take a look at the straddle and say, all right, the market's pricing in, this is going to move $1.50. Do I think it's going to move $1.50? And I'm just picking a number at random because, of course, I'm still logged out of my workstation that I was using. I can't run it on this and run Zoom at the same time. So that's the quick and dirty way to do it. As of now, I don't see the market being too fearful of the bigger bank earnings. You may see a little bit of a kick up. People who do tend to buy that vol tend to wait a little more toward the event, because if you're, as a professional, I don't love holding decay. That's one of my little things, and so I would expect to see maybe a little more of a move up in terms of implied volatility terms as you move later into this week. But that's really my thought. I guess it's good to be boring sometimes.
Yeah, I absolutely think that there will be not at the moment, but it's definitely good to be boring. And I think the Canadian banks, embody that very much. And I think that's part of why so many investors continue to hold these through thick and thin. The dividend yield and, just as you said, the franchise value long term, that has a lot of benefit for a lot of investors here in Canada. So, you know, I agree with you on the Canadian bank side from the perspective of, I don't think you're going to see some major surprises here on earnings. I think it'll largely be a non-event. You know, the implied vols certainly suggest that in terms of the at the money straddles, not pricing in anything huge here. You might see a bit of an uptick, because the bar has been set pretty low, I would say, similar to what we saw here in the US. You know, we had a pretty record earnings season in the US in terms of the number of beats on both earnings and revenue, especially from the bank side, but that was partially due to the fact that the bar was set so low. So you might see an initial pop here, but as we saw in most of the US banks, they gave back most of those gains within a few trading days or a couple of weeks. Some of them, like Morgan Stanley, trading a little higher because, you know, they're about to integrate E-Trade into their business. So there are other things in play there. But for the most part, the banks tried to rally, but hasn't really, you know, continued that move higher. And that's my expectation here for this particular earnings season.
Now, one thing that the Canadian banks have over the US banks is a lot of the outperformance. First of all, in general, the analysts seem to have gotten it wrong across the board in a wide range of industries. But in the US banks, you saw some of the firms do really well on the trading side.
You're right, exactly.
I alluded to in our intro, analysts don't care. It's like trading revenues don't matter because they figure, you know, it doesn't fit in their model. And, well, you made it one quarter. Who's going to say you're going to make it next quarter? These banks have tremendous franchises, and this is when you monetize that franchise. But for whatever reason, that gets lost. And that's why you saw the initial pop when the number came out. And then as they went through it, well, we made great strides in, you know, pick whether it's, you know, fixed income, commodities, equities, whatever it is. Different banks made money different ways, but they tend to devalue that. And I think that for the most part, you have less of an influence. You have less there. I would think the one that could be most interesting in terms of leverage to external events is Scotia, because they've got such a global focus, and, you know, so much they've got much more going on in emerging markets than, let's say, some of the others.
Right.
And they tend to always have a little more volatility to them. You know, on the flip side, you've got BMO and TD that have got great US franchises. And so each individual bank tells a different story. But if we want to look at them collectively, let me just put it to you this way. You earn far more money by leaving your money in a Canadian bank stock than you do by leaving it in a Canadian bank. The same goes for the US for the most part.
Absolutely. So going from boring and in the banks to something a little bit more volatile, gold. We've seen some very big moves here in gold over the last few weeks, moving from that 1800 level, breaking out just about a month ago, all the way up to almost 2100, pulled all the way back below 1900. This is from a technical perspective. You know, this was the type of move that I was actually looking for a lot of investors that missed out on that initial move, that just, you know, didn't want to chase that. You've had a pretty nice retracement back below the 20-day moving average and is now breaking back above it. And that's, from my perspective, just from a technical perspective, a strong signal to potentially re-enter if you're looking for a long position. So I know a lot of investors here are looking at gold potentially either as a re-entry on gold itself, but also we see a lot of investors trade the gold miners. So, and you and I had a little discussion about this, some of the risks with trading the gold miners. So, you know, first of all, any thoughts here on gold, and also, you know, with respect to trading the gold miners? I know you had some insights as far as how do you think about the gold miners? How do you position yourself if you're trading that? What to be aware of?
Well, a couple things. First of all, you know, looking at the gold chart, particularly the weekly chart, was your classic parabola. Those tend to resolve more or less in the way that we saw, which, you know, the break is sharp and short and violent. And, you know, we have retraced to the trend on the daily. We haven't quite gotten back to it on the weekly, which means, you know, that it's not necessary. We're certainly in an uptrend. We have not broken the uptrend either longer term or shorter term, the question becomes, do we retrace to the longer term trend on the weekly charts, which puts us down around 1800-ish. So it's a fairly risky time for it. I think certainly the as we alluded to, the Barrick news is exciting today. And going back to the second part of your question, how do you look at the gold stocks? For the most part, remember, you're buying something that's levered to the price of the underlying commodity. Now, with gold around $2,000, let's call it, it's not as important. This is more important right now, let's say, in the energy sector than it is in the than it is in the commodity sector, or certainly the gold sector. But what you're doing is the bigger the company, the less leverage you have, because generally the cost of production is lower. So you get more bang for your buck the higher the production cost is. And Barrick, it also has to do with the hedging strategies. Barrick had typically been, a complete hedger. They don't hedge, I think, as much as they used to. But if they've locked in their cost, depending on where they did so, it's tricky to say. But you see a Barrick or a Newmont, they are low cost, they're huge, they're low cost producers. So you actually don't have as much earnings leverage as you would if you're starting to look at smaller producers. Let's say you went down to a Kinross or even a Yamana, YRI, which more often than not, I've said various times to my colleagues, why are I trading this thing? Because it looked dead for various points. But you're starting to see, something like the higher cost producers, they effectively lever their balance sheet more because you're flipping between low profits on a low price or high profits on a high price. So that's one thing you want to think about, and realize that particularly with the junior miners, you're already making a leveraged bet on the commodity just by owning these things. Again, it's less of a situation now that we're way above everybody's cost of production, but that lesson applies also to the energy stocks, particularly so in the oil sands stocks, where we're really not at their cost of production, which is miserable now. But you start, if you start to see demand for oil push it up back above their cost of production, you get huge earnings leverage because they flip from being quite unprofitable to quite profitable very quickly. So you want to, when you're investing in anything that pulls stuff out of the ground, you want to keep an eye on what their average cost of production of that commodity is, because you're incorporating leverage just by hitting the buy button.
Yeah, so I think that's one of the most important things that I wanted investors here today to have a good understanding as to when you're trading these gold miners, that you are already trading what is an effectively a leverage position on gold, or a leverage bet on gold. So that if you're trading options on some of these, be very careful and understand that you're effectively adding leverage on top of what is a product that is already levered in itself to the price of gold. And think about it, as Steve said, from the size of the company as well. The smaller the company, likely the more leverage that is. So, but that's also why we're seeing the smaller names like Yamana moving a little higher over the past few weeks than we've seen from Barrick Gold.
Yes, you're going to see that outperformance as a result. And the other thing, particularly when it's a low price, when it's a high cost of production and a low price stock, I think that's when you really, your point is an excellent one, because you really need to think about what you're doing with this. Are you, my argument is anytime you're buying a really low priced stock, it's not 100%, you're essentially buying a warrant, because if people really thought this company was a strong going concern, it wouldn't, or if they didn't believe there was some real risk to their long-term health, or they're well managed, et cetera. So you're buying effectively some leverage when you do that anyway. And again, in the cost of if you're trading options on something that is effectively a leveraged bet, you need to understand what you're doing. And do you want to be, if you're buying a call, do you want to be doubling down, so to speak, or if you're buying a put, how much I want to be hedging at these prices, kind of thing.
Yeah, absolutely. So with that, I think that's a good transition over to our last thing that I wanted to discuss with you, which was the dollar CAD. And I think this is very much in the same vein with respect to the rally we've seen in gold and the decline in dollar. We've been talking about this for about the last month or so, ever since the dollar index broke below this $96 level, which has been which has largely been a support level for a long time here for the dollar index since pretty much December 2018. We broke down below that level here in early July early July, and we've continued to move lower. It consolidated for quite a bit for a few weeks, but is now starting to break lower again. I think this is a potential continuation, and you know, I was a currency trader for a long time, and when you look at dollar CAD, there's really two main drivers of it: is the interest rate differential and crude. Of which crude we haven't seen the move here in crude just yet, but the interest rate differential right now between the U.S. 2-year and the Canadian 2-year is fairly substantial, and I think that is causing the dollar CAD, even with crude not moving, dollar CAD has broken below that 134, 133 level, which is held for quite some time and has been a major line in the sand, I would say, since 2019. We've broken below that. So I want to get your thoughts here on dollar CAD, further movement to the downside here for dollar CAD. And what are your thoughts as far as, the interest rate differential and how big of a driver that is?
The interest rate differential certainly can't be ignored, because you've spent more time trading currencies than I have, although I do trade currencies. It's certainly always a driver. It's always a driver. Now, you showed the U.S. dollar chart before, sort of the global, the DXY chart, and that I would have said that was becoming a very crowded trade, and it might be becoming even more crowded. I do understand the fundamentals behind it. There are some very prominent economists who've laid out a very solid case for why the U.S. dollar remains under pressure. Now, I don't think the U.S. is not necessarily unique in having huge borrowing needs, but that underlies their thesis. Going over to U.S. Canada, the crude is always important, but there isn't a ton of demand. People are more mobile than they were, but they're not as mobile as they can or will be. You don't see people really flying. I saw a shot yesterday of a guy who routinely flies from Denver to Washington. He was in Denver airport, and it was like a ghost town. That's one of the busiest airports in the world. And so I don't see that crude has the huge move. On the chart, yes, we broke down through 133, but if you look at the weekly chart on the left, we can spend a really long time sort of bouncing between 130 and 133. So I would say that yes, we're at the longer term trend line here, and the trend as always remains your friend. It is a bit extended. The move up above up to 145 was sort of a panic shot anyway. So I kind of want to discount that. But when you look at it longer term, the 130-ish level has held for quite some time. And so I would expect to say that we've kind of come back to the 130, 133. Yeah, and as you go back, you see that this is kind of the 130 is the steady state. Now, yep. Can that longer term trend line start to turn lower and cause the long-term trend to move? Yes, that can. But that's not imminent. So I would, if I were trading the Canadian dollar right now, I would use the mindset that A, it's had a big move in a short period of time, and B, I think it'll take a lot to get it through 130. So without putting specific time frames on it or specific numbers on it, that would be the mindset I would be using in my dollar CAD thinking.
That's good to know. I have a short dollar CAD position. I haven't quite figured out exactly where I'm going to start taking profits just yet, but I think you've influenced my views a little as far as maybe being a little bit more conservative as to when I'm going to be taking profits on those. Well, Steve, this has been fantastic in having you on board and sharing your insights here with us. I do want to give our investors some time to allow you to let them know as far as if they want to find out more about your firm and how to get access to some of the research that you and your team puts out, where can they go to reach that?
Well, Interactive Brokers, Traders Insight is where I put up usually mostly daily commentary, sometimes written, sometimes video. And so Interactive Brokers Traders Insight is a place to learn more about what I'm saying. Interactive Brokers, of course, .com, interactivebrokers.ca we consider TMX an important partner of ours. And so there was one question which I'll answer if that's okay, and
Yeah,
that is
absolutely.
does IB allow multiple leg options in the same order? Yes, and I wrote about this recently. Not that it is on the OptionsPlay section of the TMX website. Yes, we do multi-leg orders, and the commission is sort of he asked about commission. I don't actually, I should know the commission schedules. I don't, except to say that they're very low. He asked if we have a discount code. No, we don't, because we already charge low fees. But we would love if you, and I saw you popped up there, interactivebrokers.ca, and Tony, I think that would be very helpful. We would love to see people join in. As I mentioned, I've been a part of, TMX and I have been joined at the hip pretty much since 1998, and we continue to be that way. And I'm working, we as a team are working on some stuff with TMX. It's going to be very exciting as well. And so please stay tuned. And I really appreciate you giving us the chance to do the little shout out there, Tony. That's
Oh, no, of course. And Steve, I will say that, one of the challenges for retail investors trading in Canada is not many of the brokers don't have access to multi-leg spreads. So trading even a vertical spread, a calendar, a diagonal, we don't even talk about iron condors and butterflies, just because 3 or 4 legs is almost non-existent. So Interactive Brokers does support, if I'm not mistaken, at least 4 legs in Canada. So you can trade iron condors and butterflies. The second biggest challenge, I would say, is commissions. In Canada, they have not moved to $0 commissions like the US has. The fee structures are very different. The economics are very different from market makers up there. So the cost of trading is very expensive when it comes to trading spreads. So one of the things that I have had comments from a lot of investors is the fact that Interactive Brokers commissions are substantially lower in Canada. So for those of you that are sensitive to the transaction cost, meaning you're trading a relatively smaller trading account and you're looking to trade those multi-leg orders, I can tell you that many investors in Canada trade at Interactive Brokers for that very reason.
Yeah, that is true. I know that's the case, and I know that, quite frankly, I know of many professionals who use Interactive Brokers for their personal accounts in Canada. Our prices, this price, as you mentioned, the fee structure is higher for both stocks and options in Canada than it is in the US, but I don't think the economics, the way the exchanges work, are very different. And so I don't think it lends itself right now to the zero commission environment. But
Right.
what I would say is the advantage of using a multi-leg spread is enormous, because the market makers on the other side can react to those. So really, you can. One of the things you should always be doing, and I'm just going to tell you this because now here's my chance to reveal a little bit. Couple things, and this is some of the market making stuff, and I hope you don't mind me taking this direction for the last couple minutes.
Please
This
do.
is stuff. First of all, generally, if you place an order inside the bid offer spread, but close to the offer or close to the bid, there are algorithms that will come and hit you or take you. And so that's generally something you should do. It's usually people always say, oh, the market maker moves away when they see my order. If it's a under 10 lot order, especially, they're just happy to take it. So they're not going to move as a result of it. It's worth trying. Also, if you're going to do something like a vertical spread, which is one of my favorite types of trades, because it really allows you to define your risk and reward very nicely. And for the most part, you're not blowing through a trading range. Depending where you set it, you're not blowing through a trading range that you regret not, having given away some of your upside. You can even sort of price those inside the market as well. So you look at two. If you want to do it risk free, without the ability to do multi-leg options, what are you going to do? You're going to pay 2 bid offer spreads, or you try to leg it, but then you have execution risk. Well, in this case, if you price it as one particular trade and then do the trick that I just told you of putting stuff inside the bid or the offer, but close. I mean, if you put it midpoint, nobody's going to come get you. If you put it a penny or two, or below the offer, or above the bid, somebody might step up and do that. And so what will happen is you have it, and this way you'll at least put on your trade all at once. You'll save some transaction costs. One other thing that I love I've told people, I haven't had a chance to do this in a long time. It was a few years ago that I did like a little road trip with the exchange for some of their options education stuff. And we went to Toronto, Montreal, Vancouver, and that was my chance to tell some of these secrets. And I haven't had a chance since then, so bear with me. And one of the things is, if you're rolling, don't wait till 3:30 on Friday to roll. Your prices are going to suck. Sorry, I shouldn't. Your prices are not going to be as good as they would otherwise be. Try to do it a day in advance, or at least that morning, because someone's on the other side and doesn't necessarily want your position that's expiring right away. So you tend to do a little bit better if you roll your positions. And again, by the way, this is where multi-leg options are helpful, because you can do a calendar that way. Try to do it a little in advance, because one of the complaints I got, this was a few years ago, was, oh, it's terrible. I'm trying to do it 15 minutes before the close and the prices are lousy. Yes, the prices are lousy. Think about, does the person on the other side want to be doing that trade 15 minutes before the close? Not necessarily. So that's where it comes in very handy, because you could do a calendar spread, and you could do it in the morning when the prices are a little better on the stuff that's expiring. And that's another little helpful feature.
I think that's fantastic insight. Placing orders inside the spread. We always tell investors, never ever pay the advertised price, if you will, the bid ask offer. Always put in your own order. Think of the market as a big auction, and you are basically putting your offers or bids out there, just like the market makers, and you can see if they'll come in and fill you many times, especially, as Steve said, when you have a relatively small size trade, meaning you're not trading a 100-lot order. You'll likely get interaction from the market makers, many times electronically. And I also, one thing I did, and your note about not rolling, waiting the last 15 to 30 minutes to roll your order on Friday afternoons, that's also great insights. But one thing that I do want to point out, especially when it comes to vertical spreads, one thing that you said in the beginning, which is, as a professional, you don't like to own decay, meaning you don't like to be just long the call or put. Vertical spreads are an extremely useful way where you can have that decay, but offset some of that with a short leg at the same time. So trading a debit spread where you're predominantly long that call or put, but you've offset some of that decay with a short call or put against that. That is how professionals will basically own decay, if you will. So vertical spreads, multi-leg spreads, very, very useful for trading. So Steve, thank you so much for taking the time out here today and providing your insights. I really appreciate it. Any last words before we sign off here for today?
Always manage your risk is all I can say. Is just don't get out over your skis, and make sure if you're doing well right now, that's wonderful. Figure out what can trip you up, because markets have a way of making most people feel miserable at some point, and you can feel great, and just always have one foot, at least know where it's like being in a crowded room. You want to know where the fire exits are. You should do the same with your portfolio. Know where you might have some risk. And so if you're not going to actively hedge it, at least know where it is. I tend to like to hedge, but that would be my final piece of advice to the room.
I think that's great advice. That's some of the things that we teach here, is always think about your risk first. Never think about what your potential rewards are until you first determine what your risk is and determine that you're comfortable with that risk. Otherwise, you're going to potentially get yourself into some trouble. So thank you so much, Steve. I hope you have a great day. And everyone else, I hope you guys have a great trading day. We'll be sending out the recording for this after we finish here today, along with the slides. And thank you so much, Steve. I hope you have a great day.
Same to you, Tony. It was a real pleasure. I look forward to doing it again soon.
Sounds good. Have a good one, everyone. Take care.